All right, welcome back to the daily review. A lot of people were asking me today how I got my entry, how I was able to buy right off the low of the Judith swing, and that's basically what I want to go over here. I want to also go into bias, low-hanging fruit objectives that we've been targeting over and over and over again this entire month, and how to determine them, and how they really help you build consistency and confidence in your trades over time. So if we're looking at this 4-hour chart, we see that we're in a clear range. But I don't care about this low in here or this low. Why? When you zoom out to a higher time frame, especially this monthly chart, we displace higher over this March 3rd monthly SIBI, sell side imbalance, buy side inefficiency. We displace above it, close above it. As soon as we close above it, that's confirmation. That's confirmation that this is an inversion. If we go to the weekly chart, because we've inversed that, I'm looking at this area inside of here as a breakaway gap. Price should not return back into here if we're super bullish and aiming for these highs. Daily chart, we've had just been working inside of this SIBI here. And then we'll go into a lower time frame and look at that weekly gap. But if you note the highs and lows of these quadrants, that's what you want to be looking for. This is how you determine an intraday bias inside of a range. How do you know what liquidity pool it's going to go to? How to gauge order flow of that daily candlestick and trade that power of 3. So when you look at this 4-hour chart, I'm going to remove these quadrants. We drop down into this consequential encroachment, trade up higher, close it back above this inversion, and leave a very, very small BISI. Buy side imbalance, sell side inefficiency. So when we're going into open, what we want to look for is if price is willing to trade down into here. Because this SIBI and this BISI creates a balanced price range. Going to that hourly chart, it's super clean. We have this high and this high. Two super obvious draws. Buy side and buy side. If you're looking at this range that we've been in, you have to look at who's being hurt inside of here. Where's the damage been done? Well, it's clear. Low taken out. Low, 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 taken out, low, taken out. We keep digging lower and making lower lows, but we're leaving the highs intact. When you see that, that's a very clear sign to us. It's very clear that price is just building up this buy-side liquidity. It's engineering this liquidity and slowly harming anyone that's trying to long inside of this range. So now when we're going into open, we want to look for what is our very clear objective. What is super obvious to us that just jumps out right at us? And that should immediately be these highs for you. These highs inside of here are super smooth, and they're also London buy side. Price digs down into this low, and now let's look at these lows on a lower time frame. So inside of this, you have this low, you have London leaving relative equal highs, price drops, comes right a few ticks to that low. Why? Because as price is dropping, it's leaving all of this buy side, all that low resistant liquidity. Price has a little bounce, just generates more sell side, digs into it. Now going into open, we want to take the range from 7 o'clock and move it forward. Why do we want to do this? Because this is going to be our pre-market range of where the liquidity is residing. So we dig in, we put in a low inside of that 4-hour inversion, and price rallies higher. Price rallies specifically to 50% of that dealing range. At that equilibrium price point, we're either going to see a parabolic move higher or we're going to see a reversal. So price is consolidating. It's in time distortion in here. That's all it is. Now, we have a very shallow dig on the NASDAQ here. And when we compare that to ES, it's a little more prevalent here. This is why I elected to trade the NASDAQ over the S&P this morning. It's super obvious price is going to want to draw into that and dig it one more time, at least. Now, looking at this chart, I want you to mark out what you see in here, what you think is prevalent in your own chart, and then screenshot it. And then we're going to look at my example. All right, so your chart should look something like this. Going into open, what are we expecting? We're not expecting price to just have a straight shot up. That rarely happens, and this is what I see a lot of novice traders do. They'll go in, they'll find one fair value gap, maybe before 9:30, and they'll be trying, okay, 9:30's volatility, we're going to go in, and we're going to just run right for this buy side. That's not how it works, and that's not what you expect. Every time I'm going into 9:30, I'm looking for the Judith swing. So 9:30, we open with a very small opening range gap. So that immediately is telling me to be more fickle, to be more patient, to demand accuracy from the marketplace. So price drops hard. Now, when I'm journaling, I'm measuring each size of these candlesticks, because that's really going to help me determine where that final terminus objective is going to be. If right off open, the candles are 5 points large on the NASDAQ, my terminus objective should not be 300 points away. Price is probably not going to be volatile enough to reach that. But when the candle starts becoming 20 points, 28 points, 42 points at closure, and so on and so forth, that volatility is in the marketplace. It's volatile enough to continue higher. Buy side, and etc. So that's the first thing I'm looking at inside of here. Price is dropping, and it's dropping, and it's dropping, and it's dropping, and we take out that low. So in here, this new week opening gap, consequential encroachment, the 4-hour inversion fair value gaps, consequential encroachment, plus that 4-hour BISI. We have SMT, and we're in a bullish market. So all of this is telling me what? This is telling me this is the Judith swing. So what do I need to see? Well, I'm not just going to buy that low randomly, just because we have all of these things aligning with each other. I'm going to go into a lower time frame chart, and I'm going to say, if price is bullish, and it's going to rally higher very quick, how is it going to do that? What can I expect it to do? So inside of this, you have a low, a high, and a lower low. Advanced breaker block theory. Definitely recommend watching that video. But we have this inversion right here. Consequential encroachment on a 5-second chart, by the way, that shows you algorithmic delivery. Price rallies up, drops back into it, but on this closure right here, that's confirmation that you can have a very, very low risk buy. How? Why is that confirmation? Because in here, I'm perfectly fine with risking a very small portion size to reach for a very nice risk to reward. Now, while risk to reward is always a hypothetical in your model, and it changes every single trade, this is still part of the low risk buy of a market maker buy model, right? Original consolidation, first stage, second stage, fair value gap at an expected reversal point. Low risk buy. First stage, done. This is how we're using the narrative of the marketplace with the draw on liquidity and combining it all to have these very, very precise trades. That's how I'm anticipating this Judith swing occurring. Price opens up with a volume imbalance. Now, we've gone over this a lot in our server with the volume imbalances and how I use them. Price should not, if we're truly bullish in here, price should not trade back below this candlestick's low in here when that volume imbalance opens. What I'm expecting is for price to just have a very small wick down and then expand higher. That volume imbalance in there is showing me personally that the market is strong if we don't close bearish on it. So price opens up, it wicks down, which is filling in that volume imbalance, which overlaps with that 4-hour BISI high. Boom, and it's off to the races. Price moves up higher. 15-minute BISI, which now becomes reclaimed. Daily CB low, uses it here as an inversion level, and then we run London buy side. So when you think about all of that narrative behind it, the trade is not that complicated. It's really, really simple. So let's go into how you could have entered this trade even without buying the turtle soup down here. As soon as this 937 candlestick closes above the first presented fair value gap, this is now becoming an inversion. That right there is confirmation that this is an inversion. The best inversion fair value gaps stay above 50%. So we're not expecting price to have a deep retracement in here. In fact, it's best for this to stay as a breakaway gap because it's going to want to leave all of this price action. We've gone back and forth and back and forth. All of this in here, that back and forth price, this is now a balanced price range. So when price is going to want to leave this at the correct time, 9:30, when you have that volatility, with 9:45 news, and then 9:50 macro, all of these things right one after each other, this is when we're anticipating a low resistant liquidity run to at least this buy side liquidity. Now, if you check my Twitter, I took my partial off at that opening range gap, mainly because of Apex, but it also helps show you guys that I do exactly what I teach you. This is how you grow. You can't, as a beginning trader who's still developing, go for a 120-point trade every day. One, it's not going to present itself to you. And two, if you can't even hit a single, you're not going to hit a home run. That's completely asinine. So right there, or at 938, the retest of that. That can be your entry. There's so many things inside of here that you can enter based off of. Price closes above the opening range gap. Uses that low of the opening range gap right in there. You can sit here for hours and pinpoint precision. Here you have a propulsion block, order block, propulsion block. Propulsion blocks should not be traded to 50% of. Price trades down into it, gone. So you have to pick something that fits you, that works well with you. Doesn't have to be the turtle soup or first fair value gap. Doesn't have to be an inversion. It can be a breaker block. It can be an order block. Change in the state of delivery. which an order block is a change in the state of delivery. But it doesn't matter. As soon as you have the drawn liquidity and the narrative behind your trade, the easiest thing to do is to enter. There is nothing inside of this that makes finding this draw complicated. These are relative equal highs. This is the chart jumping out at you, screaming, "Come get me." How is it going to do it? It's going to drop, manipulating lower, taking out that low, forming SMT, and moving for it. Damage is done to anyone trying to long. Price rallies away super fast. So now they're thinking, okay, well, now I have to chase price. And I'm not going to chase price. Or now they're thinking, okay, we're bearish now. We had a big drop, retest. Boom. Now, that's not what we're looking at. We're using the narrative. We're using our model to align ourselves with the order flow to reach the drawn liquidity. It's never a pattern trade. You're never going in looking for a pattern and smooth braining that entry. Everything is calculated and precise, and you get there by journaling. So a lot of people ask me, how do you journal? Well, for example, inside of this, I'm looking at how long was that consolidation. Well, it was 52 minutes until 9:30. And then I'm going to say, how far did 9:30 drop in that price run? 112 points in 4 minutes. Then I'm going to look at this. In here to opening range gap. And then how much time did price spend inside of this range again before moving away? When it started moving away, what time did that occur at? Right, it started at 9:56 with the spooling even higher during the macro. 9:50 to 10:10. Then obviously you're going to write, what did you do? What should you have done? What did you expect to happen? What actually happened? These are super, super important things to note. So when you go back and you reread them, that's when you start developing. That's when you say, oh, I've seen this before. I know what I'm looking at.